world is divided into two camps on the view of where the stock market is going. About, I don't know, half or a big segment think it's going to continue to go up. Quite a bit of views of that. And there are also plenty of views that think it's going down from here. And a lot of it has to do with the time frame that you're dealing with. I'm going to approach both subjects and give you some information on both sides. I'm Ben Reppond. Welcome to my YouTube broadcast. Today is November 4th, 2025. First, I'm going to give you economist Ed Dowd, and he has a negative view. He makes a number of points toward his case that the market is going down. Now, when I say that, or when he says that, I don't think it's going to happen tomorrow. I don't think it's right upon us. But in the not too distant future, that's the way I read it, there are some reasons why it will go down. There are reasons to be concerned. I would say this: it's not a question of if, but when. Maybe you could even say we're on borrowed time. So listen to this clip from Ed Dowd.
So the broad market has been led by the Mag 7 to 10. It's an AI bubble. If you look at the value line geometric index, which is 1,700 issues, the high was put in 22, then a lower high in January, February of this year, and we're still not back above that high. So we've had 3 lower highs in that broader index. So this is really a very concentrated, broader indice stock market bubble being driven by AI. And a lot of people have been saying it's a bubble for a while, but those voices were small and kind of ignored. But now we have, the Wall Street Journal today, questioning circular financing deals and asking, is it an AI bubble? So consensus seems to be it's a bubble, but the consensus now is, yeah, but it's going to go higher. So, that kind of logic is never, you don't want to hang your hat on that. And, look, we are now starting to see cracks in the credit markets. Interest rates are decidedly taking a tick lower, which is indicative of slowing economic growth. Inflation is going to be something that was on everyone's mind. That's going to be in the rearview mirror. We put out reports in January indicating we thought interest rates were going to go lower, oil prices are going to go lower. And real estate is going lower, just not well. It's an opaque market, so that'll take time before it hits the headlines. And we're just waiting on the stock market people to figure this out. The bond people are starting to figure it out. The smart money on the sidelines is starting to allocate money to the recession trade slowly. It's not consensus yet, but you can see it in the markets. The 30-year bond is now well below 5%. The 10-year is below 4%. The 2-year is at 3.48, and the 3-month T-bill continues to hit new 52-week lows. Interest rates going down is not a sign of growth. It's a sign of a slowing economy. And the markets are leading, and the Fed is behind the 8 ball. They've kept rates too high for too long. And so if you're looking to the health of the economy based on headline indice numbers, the SPX and the Dow Jones and the NASDAQ, you're going to be led astray, because when those 3 indices figure it out, and they will, it'll happen quickly. The bond guys are always ahead of the equity guys. I was a fixed income institutional investor for HSBC. Then I became an equity guy after going to business school. So I've had a lot of respect for bond people. They tend to focus on these things earlier. The bond markets figured out what was going on in the great financial crisis well before the equity people did. And I remember being at BlackRock, and we'd had a meeting every day, and the bond people were, fearful as all hell in these morning meetings all throughout 2007. The equity people were still partying like it was no tomorrow, saying that everything's fine. So the bond markets will prove the equity bears right at some point. I don't try to time. I don't recommend shorting to anybody or any of that nonsense. My recommendations have been a healthy portion of dry powder cash. If you're more speculative, you can get into longer duration U.S. Treasuries, and a healthy portion of gold. The gold calls worked out Gold, I think, is going to consolidate for a while now. I mean, it had a 60% move this year, and it kind of had a blow off top. And it's not the end of the gold bull run. We're going to go sideways for a long time. I think maybe three to 12 months.
So the second piece I want to play for you is Andy Sliman from Morgan Stanley, and he gives reasons why he thinks that the market's going to go down probably before it goes up very much further, that maybe we're in a bubble or the market is overbought, downside risk is greater than upside opportunity, etc. And he states that he believes that we are at the end of a bull market. A lot of people will agree with that, but it depends a lot on the time frame that you're dealing with. I think his view is a little more imminent than a couple of others I'm going to play for you. So take a listen.
Our next guest says that the market has started to show signs of an increased level of speculation. Andrew Sliman is senior portfolio manager at Morgan Stanley Investment Management. And what do you mean when you're talking about increased level of speculation, just the higher levels that we've seen of the averages overall?
Well, the bull market started in October of 2022. So we're into the fourth year. And, the rear view mirror doesn't show a bear market anymore. It shows making money. And then when that happens, as you get later into a bull market, people start thinking more about how much money they can make versus how much they can lose. And that brings in a speculative element. And you see what's worked since the low in April. It's not the Mag 7 have worked, but it's really the more speculative stocks, the money-losing, non-profitable tech stocks. That's what's worked the best. And that's a warning sign that you're late stage of a bull market.
You really think that we're late stage at this point? Because we have other people who come in and say, hey, there's a long room left to run. They don't see signs of this boiling over yet.
The late 90s were late stage, and the market went up 100%.
Right.
So you can have a long, elongated point, but what the biggest risk, in my opinion, is Fed cuts aggressively. Maybe they won't, based on what we're hearing. You have fiscal policy coming in with a lot of liquidity, and you build up this bubble faster. So if the Fed were to actually not cut rates this quickly, I think that would be good for the duration of the bull market.
You don't think cuts are necessary at this point?
No, I think too much liquidity is going to inflate the bubble more quickly.
That is the sense when you have money sloshing around. That does make people get a little worried. Meme stocks may be part of that?
Correct. And we know what happened in 2021. They went up too quickly, and then the Fed changed policy, and they went down a lot. So that's the biggest risk. But what's important, Becky, is that's consistent in the later stages of the bull market.
Now I want to play for you two pieces that are clips that are making the case for the fact that, the market's going to crash at some point, but there is a lot more upside to it now. So for the immediate period in front of us, I would say be optimistic based on what they say. The first is Paul Tudor Jones. He is a hedge fund manager, renowned money manager. He manages, I don't remember, a lot. I'm sorry, I don't remember the number, but a lot of money. And well regarded. He makes the case that it sounds like we're in the final phase of a long bull market. And this phase may be a number of months, maybe 6 months. It could even go on for a year or two. But because the market is overvalued, and it is, does not mean it's ready to go on back down. I would say that my takeaway was get on board, be prepared, however, to get off when the market sends clear signals that the bull market is over. So take a listen to Paul Tudor Jones.
Let me ask you about the markets, though, right now, because we have all these big headlines, including today. We have this OpenAI deal with AMD. AMD is ripping. There's these warrants. Some people look at these as sort of these circular deals. We had 2 weeks ago a similar deal with NVIDIA. We've got a big bank deal this morning. We're going to hear from Fifth Third's CEO in just a little bit. You were, I think, dare I say, very pessimistic the last time I saw you here back in May. How do you feel now?
Well, it's like the Prince song. It's 1999. Party like it's 1999, right? Feels exactly like 1999. I don't know whether we'll actually replay it exactly, but I think all the ingredients are in place. And certainly from a trading standpoint, you have to position yourself like it's October 99. I don't see why you would do anything but that. And remember, the NASDAQ doubled between the first week of October 99 and March of 2000. So if it looks like a duck and quacks like a duck, it's probably not a chicken, right?
But you think it's 99, and we were talking to Mike Novogratz earlier today. It's not 98. I mean, everyone's it's either 98, 99, but it's not 96, I guess is the point.
Right.
And that's a problem, potentially.
Right.
Or it's maybe an opportunity, but you have to get on and off the train pretty quick.
Well, if you just think about bull markets, right, the greatest price appreciation is always the 12 months preceding the top. So that's the nature of a bull market. It kind of doubles whatever the annual average is and before then. So if you don't play it,
right,
you're missing out on the juice. If you do play it, you have to have really happy feet, because there will be a really, really bad end to it. And my guess is that I think all the ingredients are in place for some kind of a blow-off. Will it happen? Again, history rhymes a lot, so I would think some version of it is going to happen again.
Right.
If anything now is so much more potentially explosive than 1999. 1999, we were looking at a rate hike in November. Now we're looking at a rate cut. We were looking at 4 more rate hikes before we actually topped in 2000. Now we're looking at 3 or 4 rate cuts, probably at least. So you have monetary policy that's going to take us to real rates of 0 or less, probably, depending upon the next Fed chair. And then the big difference is, obviously, fiscal policy. We had a budget surplus in 99, 2000. Now we've got a 6% budget deficit. So that combination, that fiscal monetary combination, is a brew that we haven't seen since, I guess, the post-war period, early 50s, something like that. And that was crazy times, right, coming out of the war.
Well, you think that most people who are watching us now, you need to be in this market now. But then the question, as I said, is you have to jump off the train before the train crashes. If you're suggesting the train is going to crash.
I'm not suggesting the train's going to crash. I'm suggesting that we're in a period that's conducive for massive price appreciation in a variety of assets. Will it happen or not? I don't know. If you kind of just look, if you just think about the leverage that we had in 1999, you look at margin debt, and then you look at today margin debt, but you have to throw in leverage ETFs because people don't use margin like they did back then. We're probably a little more elevated than we were in October of 99. It will take a speculative frenzy for us to elevate those prices, right? It will take more retail buying. It'll take more recruitment from a variety of from long-short hedge funds, from real money, et cetera. It'll take a combination of those things. It's not going to go up without flows and without a story. The story's there. It's the combination of the most unique and aggressive fiscal and monetary conditions that we've ever seen.
Okay.
Finally, I want to play a final piece from David Hunter, and I think he makes a very good case for the fact that the market is going up from here before it collapses. And he has a positive view. He has been on both sides, by the way. I followed him for a while. He's had a view that things are not very good, and he will tell you that. But right now, he's got elevated price targets for the S&P, NASDAQ, Dow, et cetera. He'll tell you what those are. But he said, and what he's done is significantly raise those targets because he is so optimistic about where it's going, and he tells you why. He makes the case that the market could easily go 30 or 40% or more up from here. Now, we're not used to that because we've been in a kind of a normal market, but this is what he calls a parabolic market, a blow-off market, where it's just this last phase of a bull market is where it accelerates. And we saw that recently, the last few months with gold and silver. And I think he believes that you can see it, he will see it in this last phase of the bull market. My takeaway is that you definitely, if you follow his advice, you definitely want to be invested right now, but be prepared to get out when the music stops. Our approach to investing is exactly that. We have a technical indicator, internal market indicator using intermarket analysis that tells us when the risk is lower to be in the market and when it is not to be out of the market. It has been this year, and I believe most of last year, has been positive almost all of the time, or all but just a very small amount. And but when it turns the other way, we will be getting out. And so anyway, very interesting. Take a listen to David Hunter.
So what are you paying attention to most right now that you think should be on investors' radars?
Okay, yeah, thanks for having me on, Jesse. Good to see you again. I would say probably, obviously, it's the U.S. stock market, and what I think we have entered, which is a parabolic final stage of what I've talked about as a 43-year secular bull market that started back in August of 1982. What we're seeing here is a steepening of the rally as you move into the end. And I had talked about this several years ago, that this is how it would likely end. I think we have reached that stage where it's a relentless rally. Doesn't mean you won't have sell-offs day to day, or that you couldn't see a 3 or 4% sell-off at some point. But mostly it's going to be upside and upside steep, led by tech. But there's lots of other groups that are starting to participate as well. I am putting out this is being recorded on the 7th of October. I'm putting out my quarterly letter tomorrow, where I make my adjustments to targets, and I am raising targets that are already extreme relative to anybody else on the street. I think people are coming my way, but still far below my targets. And yet I'm raising them again, and raising them pretty significantly. For example, because I assume this will come out after tomorrow, so I can say this. I think my S&P target is being raised to 9,500, had been at 8,700, so that's a big number, and already was, as I said, way beyond anybody else. My Russell 2000 numbers being raised from 3,400 to 3,800, NASDAQ 32,000 from 30,000, and the Dow to 65,000 from 60,000. So these are crazy numbers, and I do say that we're in a parabolic, so it could happen in a matter of a few months that you get to those targets. It doesn't have to. As I say, there's no the clock's not going to strike midnight on December 31st, and the market has to be done by then. It could carry over into the first quarter of next year. But whatever it is, it's fairly short term, because parabolics burn out. You go almost vertical. You cover an awful lot of ground in a short time. So whether it's 2, 3, 4 months, or a little longer than that, even doesn't matter to me. But we're in that stage. And it's obviously the thing that caused me to raise targets is because although the retail public has been bullish, and surprisingly was bullish last April when everybody was bailing out, they learned their lessons and said, we're getting opportunities to buy lower, I'm going to buy. So the retail public's been pretty savvy about this and stayed right through that period when everybody got nervous. The institutions who have fought this market from the October 2022 low all the way up and kept saying it's a bear market rally, and then when it went to new highs, they said, okay, it's not a bear market rally, but valuations are so high that the upside is limited. They've still been saying that right up till now, but you're beginning to see them finally say, we got to get on board. This is a momentum train. And so you're seeing targets getting raised on the street. You're seeing institutions having to get more aggressive or allocate to more equities. So because that's just beginning, it tells me you're going to have a pretty big rush into the market from institutions here in the next, this quarter. So that's basically why I say, I've got to raise numbers, because that's going to create a pretty big run up here.
Okay, thank you for listening, for watching. If you have questions or comments, leave them in the comments section below.